Good morning. This is Dean Tenney. I'm coming to you from my studio here in fabulous Las Vegas. It is early October. Our YouTube channel's been up now about 10 months, going into our 10th month. And if you are watching the Series 66 explication practice final, remember you can always hit pause, attempt to answer yourself, and then move to the next performance opportunity. We always in the channel try and provide, in terms of content, to support you. It's supplemental, not a substitute for your study materials. But we always try and provide you with some narrative lectures. Yeah, the 66 playlist includes 2 narrative lectures, one on the Uniform Securities Act and another on the investment advisor representatives. We provide you with explications of content outlines or test specifications. In this case, the NASA test specifications for the 66. We're working our way through that explication. We're not really quite done yet. Mostly, for the most part, we are done, but we will finish that up. So congratulations, because this would be the 3rd leg of your testing journey. You've done your SIE, you've done your 7. This should be, for most of you, the final leg of your testing journey. On the, if you know somebody that's not on their 3rd leg, if they're on their 1st leg or their 2nd leg, their SIE, or the Series 7, refer them to the channel, because we have all that stuff complete. There's narrative lectures, there's explications of test specifications or contents, and there's a practice final. So this will be the first practice final for 66, and hope it's helpful. It's not a diagnostic. It's a way to share, a debrief, get you comfortable with things that are being currently tested. So, let's get busy. We have 3 finals on this Series 7. This will be the first. So what I do is I collect debrief. I'm not allowed to ask you like what was a particular question, but I can say, hey, what do you think we could have done a better job for you explaining, or whatever the case may be. As I collect that, when there's enough to support, sharing in the form of a practice final, I do so. So for example, in the Series 7, we have 3 practice finals. This will be our first. And again, as time goes on, we'll add to that. So if you find a question you like, hit the like button. And if you have a while, might be around while we finish up the explication of 66 and do another practice final, subscribe. And again, refer the channel to others you may know. This is very, very high probability. When I ask people, hey, did you see something about a qualified domestic relations order? It's almost always yes. Which of the following is a court order, a pension plan, to make a qualified distribution to a third party? What we're saying here is that you're not going to owe taxes. It's not considered taxable distribution. You might want to just turn this what I call a poor man's flashcard. Poor man's flashcard would mean you get rid of the wrong answers. I don't know why it's doing that. Hold on. I'll take one more try at this. And then when you're studying, maybe you just read the question and the right answer. Or maybe you make that a flashcard. Maybe you should have a stack of flashcards as you go through this practice final. All the following are true of 457 deferred comp plans, except they are mostly offered by local and state governments. That's true. They are funded with pre-tax salary reduction. That's true. The investments grow tax deferred. That is true. So what is false is they are not subject to ERISA. ERISA is the Employee Retirement Income Security Act, and it covers private pension plans. And since this is a type of pension plan offered by municipalities, state governments, and cities, counties, that kind of thing, it is exempt from ERISA. Which of the following describes the relationship between systematic risk and expected return? What you can do here is you can do what I call process of elimination. You can say, well, there's nothing in this question about a series of future income streams. And if there's nothing about a future series of income streams you're going to receive from the stock's dividend or from the bond's semi-annual interest payments, you can get rid of anything that's about that, leaving you with the correct answer, which in this case is capital asset pricing model. Which of the following theories about how risk-adverse investors can construct portfolios to maximize expected return based on the given level of market risk? Again, I would have used process of elimination. I would know the Dow theory is a technical theory, which uses confirmation of the Dow Jones Industrial, Dow Jones Utilities, Dow Jones Transportation to predict a bullish or bearish trend. I would know the odd lot trading theory says odd lotters, people who don't buy stocks in the normal unit of delivery, which is a round lot. Odd lots are typically the unsophisticated money. We should do the opposite. Short interest theory says that short sellers represent future buyers, and therefore they can accelerate a bullish trend. Kind of counterintuitive, but shorts have to buy to cover, particularly if they get a maintenance call. So by process of elimination, I would have got to modern portfolio theory. And then again, maybe what you would do is make a flashcard as you go through this practice final. And now I have a flashcard that says which of the following theories is about how risk-adverse investors can construct portfolios to maximize expected return based on a given level of market risk, and you would come up with modern portfolio theory. Securities that move in no discernible pattern in relationship to each other are said to have a no correlation. Right? We don't know. There's nothing to be discerned from that. You are going to get tested on negative correlation and what it serves in terms of a portfolio. It adds additional diversification. For example, if I already have, Ford Motor Company in my portfolio and I add General Motors, I haven't really accomplished much in the way of diversification because there's a positive correlation between Ford and GM. So when I'm trying to provide, additional diversification in my portfolio, I'm trying to pick something that has negative correlation to what I already have in there. For example, if I have, Ford, maybe I say, I'm just making this up on the fly, so it may not be the best example, but, I say, okay, well, if Ford's doesn't do well, maybe that's because Fords are on the road longer and people will buy parts, and maybe I buy an auto parts store thinking that, the manufacturer stocks go down while the parts stores go up. I might also introduce precious metals or commodities or foreign securities, something that does not have the correlation I presently have in the portfolio. Again, I said this is unlike high probability you're going to see something about negative correlation, right? And again, high probability just being asked like you are here, aim and shoot, point and click, but also this idea about adding additional diversification to the portfolio. A measurement of a stock or fund's volatility as compared to the market as a whole can best be described as, and again, maybe you want to make a flashcard for that. A stock's return in excess of beta can best be described as, a lot of people get intimidated, alpha. A lot of folks get intimidated on the Series 66 about some of the quantitative stuff. And the vast majority of the quantitative stuff is flashcard stuff. You might have to do math maybe one or two times. But, if you miss the mark on the 66 because of quantitative stuff, analytical methods is what this is called in the test specification. Yeah, you're not going to, miss a whole lot of stuff. All the following are exempt from registration under 33 and the Uniform Securities Act. All the following are exempt from registration under 33 and the Securities Act, except Reg Ds. You don't have to register a Reg D, the securities, under 33 or USA. Securities issued by the U.S. Treasury and government, yes. Municipal securities, yes. I'm looking for something that's a no. This one's kind of funky, so I would know this on your exam. So intrastate offering, I don't have to register it with 33 because an intrastate offering is exempt. We have the 80% test about being compliant with this exemption. Sometimes we refer to this language you get comfortable with as a safe harbor. It's a legal term saying you're not in trouble if you do it this way. This is a safe harbor under 33. The way I can sell securities while making a registration statement. However, that is not available to me. That is not available to me under the Uniform Securities Act. I'm still going to have to qualify this with the state administrator. So I'd use a qualification. By the way, when you're doing these practice finals, if you need to tell me, reach out to me. You can look in the bottom right, and I number them. So this is a question 11 or slide 11. The other way you can do it is by timestamp. I won't have this timestamped immediately because I put it up and then I have to watch it again to timestamp it. But you can also refer to where you're at time-wise, and I can find what you're looking at. An investment advisor representative, that would be you, has calculated the value today of a future set of dividend or interest payments. So, what I'm saying, what am I willing to pay for this future income stream? The investment advisor rep has to perform what type of analysis? Not fundamental analysis, not technical analysis. Future needs analysis is for insurance. It's not for this. Boom. Discounted cash flow analysis, right? To come up with that, what we call the present value. And maybe I think the present value is, I'll compare that to what, if there's a market price, to decide whether that's, something I'm willing to pay or not. An investor uses an expected return of 10% and their initial investment to fund a college education, but the actual return was 8. So we're expecting to get 10 and we only got 8. The future value will be smaller than expected. So we aren't going to arrive at our financial destination with the amount of funds we thought we were going to have. Which of the following uses present value of the stock's future distributions for valuation? Mr. Buffett at Berkshire Hathaway likes to buy stocks that have an income stream. For example, he owns 1 billion shares of Bank of America. Bank of America pays a 21-cent quarterly dividend. Used to be an 18-cent dividend quarterly. Now it's 21 cents a quarter. And when he says, okay, I'm going to get 21 cents every 3 months from now until, he could, in doing the math, he could say a terminal date where he's saying, I'm going to assume I get dividends for 20 years, or he could say I get them forever. And then he's going to do that thing we talked about in terms of valuing this future set of income streams and say, okay, what price would I be willing to pay for Bank of America based on the math I've done in discounting the cash flows going forward from the quarterly dividends? That's not going to be sum of parts analysis, no. Sum of parts is used by bankers, for example, like, Kaplan is a subsidiary of Graham Holdings, and Graham Holdings has many subsidiaries, and some of the parts would be to take all those subsidiaries of Graham Holdings and value them separately, and then compare it to Graham's stock price, Graham Holdings, and see whether you think it's overpriced or underpriced. Price to earnings, again, is used to compare companies A to B, but that has nothing to do with income streams. That is testable price to earnings. Dividend discount model, boom. Market price, that's called market capitalization, D. The answer is C. Now, remember, there's another version of this I hinted at. And, Mr. Buffett can assume that the dividends are going to remain constant at 21 cents, or he could assume that that dividend will grow, in which case he could justify a higher valuation, right? So in this dividend discount model, there's 2 models. One model where we assume the income stream doesn't change, for example, a preferred stock. The preferred stock dividend isn't going to change. And so you can't use the dividend discount growth model because there's not going to be growth in the dividend, but you can certainly use the dividend discount growth model as it relates to Bank of America, or Microsoft just raised their dividend 59 cents to 62 cents a quarter. So you can use it there. Here, it's just the dividend discount model. The way to remember this is long and low. Duration, I'm oversimplifying this, which is my job, but duration is synonymous intellectually with volatility. And the bond is going to be most volatile is the bond that has the lowest income stream. Because, if it has an income stream, at some point, if interest rates go up and the bond goes down, I would buy it to capture the current yield. However, here, there is no current yield, in a 0, for example. But if here we have 2, so you're going to go first. Your first thing you're going to do on the test is go with the lowest coupon. So the way to remember this is long and low. So the first thing you're going to do is go for the lowest coupon. As I just said, investments with income streams are more stable in price. By the way, that's even outside of bonds than investments without. And then you're going to pick the longest maturity. Boom. Long and low. Which of the following qualify for a tax-sheltered annuity? So not a tax-deferred annuity. Not a tax-deferred annuity. This is a tax-sheltered annuity. We're using pre-tax money. And this is for employees of educational institutions or employees of charities. An employee of a municipality, I got to change that one. Let me get rid of that one. That's not a good distractor there. I should get rid of that one. What I'm looking for here is it's not the student. It's not the student. I'll tell you what, I'm going to fix this on the fly. I just don't like that as a distractor. So discard. Thanks for your patience. We want to make sure. There we go. I just like that a little better. Oh man, school employee of the school, like a janitor or a nurse. I got a nurse in there, don't I? I do have a nurse. Let's make it a janitor. Again, thank you for your patience. Not the students, not the students. All the following are most likely an access person. So this comes from Debrief. I told you most of the time when I'm doing these practice files, what I do is save up Debrief. And I'm not sure, sometimes, I'm making up questions based on that. And sometimes I'm pretty spot on. Sometimes who knows, but most likely an access person. And here, the one who's most likely not to have access to material non-public information and be able to shadow clients of the investment advisory firm's trades is going to be this person. And so again, and all I'm asking you to do here is what I call the Sesame Street trick. One of these people is not like the other. And then remember the other test question, we have another thing that comes up on your exam is what does it mean to say you're an access person? It means you're going to have to provide quarterly disclosure of your trade, your investments with the compliance office. All the following are inputs to calculate the Sharpe ratio, except the return of the portfolio. Absolutely. The higher the Sharpe ratio, the better. We're getting better return with taking, lower risk than somebody with a lower Sharpe ratio. Risk-free rate of return, yes. Standard deviation, yes. Discount cash flow, no. And if you're going to take, you're making flashcards, maybe, you turn this into a flashcard like this, where you have those, three things. All the following are precious metals. This is comes from Debrief. I think this is stupid, but I think it's stupid. But what I think is stupid, and NASA thinks it's stupid, is not. Copper is not a precious metal. Copper is used every day in plumbing and house building. In fact, some people refer to copper as a Dr. Copper as a economic indicator, but it is not a precious metal. So anyways, this comes from Debrief. Somebody told me they saw something about precious metals, which one was not. So here's my best guess on what is not a precious metal as compared to gold. Most certainly is. Silver most certainly is, and platinum most certainly is. A client receives a positive email from a client. He responds and he close copies 3 other of his clients. So an investment advisor is allowed to share communications amongst his client. That's certainly false. The investment advisor representative has not violated the customer's confidentiality. That's, again, false. The investment advisor representative has violated the client's confidentiality. That's true. Right. Again, I'm not sure how close I came to this on Debrief, but this again comes from Debrief. Another question from Debrief: a debt to equity ratio 1-to-1 means which of the following? This is kind of, I'm wishing for you a dream draw. I think this is kind of a high end draw, but you get low end draws. Now remember, I'm about question 20 something, 23 here. And remember along the way, if you need to take a break, most certainly do. I mean, hit the pause button, come back and, do it again, right? Or pick it back up where you left off. Anyways, a debt to equity ratio 1-to-1 means which of the following? Equal debt to equity on the balance sheet. Now that's not true because, the current liabilities are also debt as well. What we're talking about here is the capitalization of the corporation. And the capitalization consists of the equity and the long-term debt. So equal long-term debt to equity on the balance sheet, yes. Equal current liabilities, nope. Equal fixed debt, nope. So the answer there is B. So, I don't know. I don't know if that's, that's kind of a, every draw is different. I don't know what to tell you about that. More often than not, what you're going to get asked to do, and I have 50 practice questions on potential math that you can encounter on the 65 and 66. I would refer to those 50 questions, and in there I have a debt to total capital calculation, and you can review that if you'd like. What is the difference between an exchange traded note, very high probability, and an ETF? An ETN is an equity instrument and an ETF is a debt instrument. No. ETFs trade on the secondary market and ETNs do not. Nope. Ding, 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 ding. That is very testable. To know that an exchange traded note is a debt instrument. So you have counterparty risk. You have the risk that the sponsor, which is a financial institution, is not going to be able to make good on whatever they've agreed to pay you in relationship to the underlying reference, whatever it's an index or whatever it happens to be. All the following need to be renewed each year, except all registrations need to be renewed by December 31st, but this is a permanent part of your record. That is very high probability. That allows the state administrator to receive legal documents on your behalf. So they can't find you. I can serve the state administrator and you're considered served. Which of the following a qualitative measure, which of the following is a qualitative measure? I'll fix that. I usually read this through a couple times, but sometimes when I get going. Which of the following is a qualitative measure? A, no, that's quantitative. Quantitative means numbers, right? So A is quantitative. B is quantitative. C, there you go, qualitative. What? I think you're going to get something on your exam high probability about long tenure by a fund manager, or perhaps even just tenure by a fund manager. And that's important again, because remember, when you're showing somebody a hypothetical illustration of the fund's performance, we want to know how much of that performance is accountable to a particular manager who may or may not be there. He may have been there for that performance, and therefore it's a more accurate reflection, or not have been there. Maybe I'd say, hey, well, yeah, if we look at the 10-year record, it's not so good, but the last 5 years have been better. And one of the reasons for that is the new team. So like that's becomes a thing. Alpha is certainly quantitative. So again, you can try and make a flashcard. That's what would be on my flashcard. Which form of the efficient market hypothesis says that all technical data, fundamental data, and private information is shared by all, and there's no way to meet the market? That's the strong form. That means probably maybe, I'll get you a index fund if you believe in the strong form of the efficient market hypothesis, right? Kind of a, the no way to beat the market thing. A present value calculation was done to determine the future value. The term was less than expected, so the future value will be, again, less than we anticipated. Gamma Global Investment Advisors acquires another investment advisor. Which of the following is true? The clients have to honor the duration of their existing investment advisory contract assigned to Gamma Global Investments. That is false. The clients may give oral consent to the assignment of their investment advisory contract. No, that's false. The clients must give written consent for the assignment of their investment advisory contract to Gamma Global Investments. Ding, 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 ding. Negative consent. A lot of 66 is legal terms. Negative consent means no news is good news. Negative consent would mean I could send you a letter and tell you that if you don't say anything, I assume it's okay. as contrasted to positive affirmation. So no, I got, positive affirmation means legally that I have to, make sure you tell me it's okay, basically. So anyways, the answer here is C, and that is very much a high risk test question. So again, maybe, if you're going to make a flashcard. Which of the following mutual fund shares classes would offer breakpoint? That's the class A shares. Remember, the class B shares would have a contingent deferred sales load. Class C would have something that they waive it. And then the class I is the institutional share class. The answer here is class A. What formula is used to find the present value of an investment by using a future value that is decreased at a compound rate over time? I'm just trying to find a bunch of different ways to kind of get you to get to this. This is kind of what I'm trying to do. So that's a pretty convoluted way to say that, but I kind of every once in a while like to, step out on that. A formula used to find the present value of an investment by using the future value that is decreased at compound rate of return. Now, if we actually knew it had the two numbers when we started, that would be internal rate of return. Which of the following is true of a qualified dividend? So, if you hold a stock for a certain length of time, I wouldn't worry about this. Usually 60 or 90 days, depending on whether it's common or preferred, you're going to get taxed at something lower than you normally would. Normally your portfolio short term, an interest you receive in your portfolio is taxed at the same rate as your ordinary income. And so this gives you kind of a benefit. So now here I'm trying to camouflage this idea that it's going to be taxed at less than ordinary income. So it's taxed at the same rate as a municipal bond. Absolutely. I'm taxed at a lower rate. Yeah, I'm making you here try and reverse engineer that would be the same rate as would have dividend on a stock in your portfolio. Your portfolio income, your investments working for you, the interest you receive on your bonds, the dividends on your stock is typically taxed at ordinary income tax rate. So that's kind of what I'm getting at in that question. 50% would be a dividend of one corporation paid to another. So that's a pretty good distractor, but the answer there is B. Chapter 7 is complete liquidation. I wouldn't worry about that. I tell you it's liquidation, but this is very testable. Now, this is the first time I've used a multiple, and on your actual exam, you could expect 2, 3, max 4 multiples of multiples. I may have a few more multiples in this explication than the actual exam because I want to test you sometimes on 4 things. And I probably wouldn't be doubt that I probably have more except formats in here because I want to be able to test you on 3 of a thing and not that false thing. And that means why I have, I think, 110 questions in this practice final. I'm able to, ask you about or share with you a lot more testable information. But on the real actual exam, maybe 2, 3, max 4 multiples of multiples. And then I told you, I think I'm pretty heavy on the except here. You definitely should be able to do this from junior to senior or senior to junior. Here it's senior to junior. So secured bonds come first, then our unsecured bonds, then our preferred stock, and then common stock comes last. I could probably rewrite a better answer set here because I could have started with, that and said, I need that to be last. And Dean didn't do a very good job on the distractor set here. I should typically have maybe 2 that end with that. But here the answer is D. Now, remember, be careful you read correctly because this could say junior to senior, in which case it's the opposite. If I asked you to go junior to senior, it would be 2, right? 2 common stock, then preferred, then unsecured, secured. Now, if I rewrote this slide, I would actually give you the version going the other direction. I don't think I have the answer set here, but I just want to show you here. It says, so now I'm asking you to go junior or senior, and that would be, I don't have the answer set correct, but I'm just showing you're going to get either version of this. You'll get very high probability you're going to get this. So now if I ask you to go this way, it would be common stock from junior to senior, preferred stock, unsecured bonds, secured bonds, right? Secured bonds, which would be Roman numeral 1. So, which of the following is not a fee that is paid by the 12B1 fee? This comes from a debrief. The 12B1 fee, remember, is a promotional expense. It is a promotional expense. And so somebody told me they got to ask what is not a part of this promotional expense. And my guess is that they were looking for you to know that the investment management fee isn't a part of the promotional expenses of a fund. That's, the person doing battle with Mr. Market on your behalf. So advertising is a promotional expense. Sales literature is a promotional expense. Compensation paid to associated persons of the broker dealer are all promotional expenses, and therefore it could be part of the 12B1 fee. Very much just name and shoot, point and click question. Now expect a question or two about this 12B1 promotional expense. If you want to refer to yourself as a no load fund, the maximum 12B1 fee you can have would be 0.25. That's 0.25%. A customer purchases, this is very high probability on an exam. A customer purchases 100,000 S&P 500 index annuity with a 60% participation and a 5% cap. The S&P grew 11%. So 11% of $10,000 is going to be 11,000. And we have a 60% participation rate times 60. That's 6,600. So that means it says it has a 5% cap. So the 5% cap means it's going to go boom, right? You don't get more than 5. And then the reset next year, it fell, is still going to be 105. So I wouldn't get too hung up on the math here. The math isn't the point. What people, when they encounter this question, forget is there's no negative reset. And that's why it's not considered a security, because there's no way you're going to lose money or principal value in this equity index annuity, right? So again, it's not so much can you do the math here, is do you are you on the test, you realize there's no negative reset. It's not going to be a negative number regardless of what happens in the market or whatever the index that is being used is. Which of the following would qualify for soft dollar compensation by the broker dealer to the investment advisor? Investment advisors are very, very important customers to broker dealers. And what broker dealers can pay for is to register you for a seminar. It's very testable to know what they can't pay. Which of the following paid by the broker dealer would qualify? What they can't pay for is travel, furniture, and rent. By the way, that's more often than not, the test question is not what they can pay for, but what they cannot. Cannot. Large cap, the benchmark would be the S&P. Benchmark is used to gauge my performance. It's particularly important if I'm going to have a performance-based fee. I got to tell you, it's based on the performance of. For example, one of the few public mutual funds I know that has a performance-based fee that goes up is a Fidelity. So Fidelity says if we outperform the S&P 500 over a rolling time frame, we want additional compensation. All the following are true of a broker dealer acting as a third-party solicitor, except the broker dealer does not have to register to investment advisor. True. As a broker dealer, if a broker dealer is hired by a federally covered investment advisor to raise money, find them, partners for their funds or their investments, that's fine. That happens all day long. And broker dealers are acting in their fundraising capacity. They don't need to register to investment advisor. If I'm a 763 who works at the broker dealer and I'm an associated person of a broker dealer, I don't have to take and pass a 65 or a 66 when acting on behalf of my broker dealer and helping a federally covered investment advisor, raise money to manage. The broker dealer only needs to deliver its brochure. And that's not true. That's why this is the answer. I have to give you 2 brochures. I say this brochure tells you about my broker dealer. This brochure tells you about the investment advisory firm that has hired my broker dealer as a third-party solicitor. Then my, investment advisory firm is going to want the client to acknowledge that I've given both those brochures to that client. And then I have to tell them again whether it's going to result in any additional fees they need to pay. All the following are part of the definition of an investment advisor, ABC. Do I hold myself out as giving investment advice? Do I tell people I'm in the business of giving advice and I want compensation? So, how I'm getting paid is not so much. It's, by the way, I want you to get comfortable with this language on natural person. That's your firm. So as I mentioned to you, the answer here is D, by the way. That's a separate issue. I'm going to get paid. A, B, C, A, B, C. Anyways, a natural person is a living, breathing human being, right? So you are a natural person, but your firm is a non-natural person. So unnatural persons are not living, breathing human beings, right? So sometimes people get hung up when they hear the broker dealer referred to as a person or the investment advisor referred to as person. Just legally means they can be held accountable. It's a legal definition, right? And then unnatural persons. This was an investment advisory firm, and the guy who's in charge of this firm said, "My firm will plead to a felony, but not me." He's saying the unnatural person, the investment advisory firm will plead to the felony, but not him. He was going to contest it because you can't throw an unnatural person in jail. Under the Uniform Securities Act, you can request a review of the state administrator's order 60 days from that state administrator's order. How many days? All the following natural persons are investment advisor representatives, except. So again, they love these Sesame Street kind of tricks. And so a Sesame Street trick is one of these things is not like the other. Solicits new business for the state covered investment advisor. Yes. Supervised investment advisor. Yep. Yeah. Here, boom. Right. The receptions. With custody, aim and shoot. You don't get many aim and shoot point and click questions. So make sure if you get a aim and shoot point and click question, you're able to perform. Again, here I would make my flat line, which represents a bond at par. It has a 7%. It has a 7% nominal yield. It has a yield maturity of 5%. You're going to encounter that, at least once. And then remember, the whole point of this bond at a premium is you probably should know the yield to call, because right now interest rates have gone down, causing the bond to go up. That's why it's trading at a premium. And it's very likely that that remains the case, that the bond will be called away from you. And so you still may want the bond, but you'd want to know what that yield to call is. An investor pursuing an aggressive investment strategy, which of the mutual funds is most suitable? So here we're just asking you, again, if you are aggressive, you're going to need to go faster. And so you would want the fund with the highest beta, right? I say, unfortunately, we're going to have to take a little bit more risk than I'd like to get you where you're at. So we may be choosing to be aggressive here. You just point blank told me you're aggressive. So if you can handle the volatility, then why not go for it? If an issuer will be registering their security with the SEC and a state or states, which method? Well, if there's going to be more than one person involved, we're going to use what's called coordination. Which of the following must investment advisor consider when placing a municipal bond in a client's portfolio? Definitely the state of residence, because remember, California can and will tax you if you buy a bond not from California or political subdivision of California if you're a resident, right? So that's certainly important, or whatever state we're talking about. Your tax bracket certainly important. Your credit rating, absolutely. All of the above, which form of efficient market hypothesis says that all technical data and fundamental data is shared by all, and so the only way to beat the market is with private information. That's the semi-strong form version of that. Hypothesis isn't truth. Hypothesis is just a way of explaining things. And the more a theory can explain, the better that theory is. Your customer has a bond with a coupon of 7. This is very high probability. CPI was 4. So all you got to do is take the customer's return minus the CPI, which was 4, and you come up with 3%. That's called constant dollars. Constant dollars are dollars measured for inflation, in dollars measured for inflation. Which of the following benchmark for a small cap stock? And again, if you're making flashcards, maybe you just want to get rid of the wrong answers to these questions and just make a flashcard for it. I think flashcards are very underrated as a study tool. All the following are true of a 457G plan, deferred comp. So deferred comp, it's a type of non-qualified plan. Yeah, non-qualified means it doesn't have to comply with ERISA. So you got to be a little careful on this one. What I mean by that is usually when we say non-qualified, you're using after-tax money, but not in this. It's a type of deferred compensation. Yep. It's typically offered to government employees and select employees of people who may work for this. So let me get rid of that. I got a better version of this now that I like even better. But typically offered to government employees. Yes, it's not governed by ERISA. That's the point. I think I've got two versions of this because people keep telling me they run into this on the exam. So again, the flashcard I would make if I were use this idea here that's not governed by ERISA. All of them are not persons. Remember, person means can be held legally accountable. So all the following are not persons. Not persons means you can't be held legally accountable. Minors can't be held legally accountable. And again, I think where a lot of people get hung up on their 66 is a big component of is a legal test. Deceased individuals can't be held legally accountable. Persons declared mentally incompetent can't be held legally accountable, but you most certainly can, right? So you are a person. And remember, you're a non-natural person, but you're a person. These are not considered to be persons under law. Meaning they can't be held accountable for their behavior. Release 1092 expanded the definition of investment advisors to include all the following, except. Financial planners said, well, I'm not sure if I meet this definition. Pension consultants said, we're not sure either. And agents said, well, and the SEC said, well, let's give you a release and let's broaden that definition. And so, no, broker dealers were always, if they're selling wrap accounts, we're always part of that. You're charging fees, but the ones that it was specifically about, so that's the answer there. But again, if you're making a flashcard, I get rid of the except. And I get rid of the right answer, and then I'd put these as my poor man's flashcard. That's what that release was about. Both investment advisors and investment advisor representatives may meet the de minimis to not register in a particular state. Which of the following is true of the de minimis exemption? No more than one office or place in the business in the state, and 6 or fewer individual retail clients in the state. That is not true. If you have a place in the business in the state, you're going to have to register. No office in the state or place of business in the state, and fewer than 6 individual retail clients in the states. Sounds pretty good. You always want to make sure you read the complete answer set to see if you don't find one you like better. No office in the state and all retail clients are snowbirds. Well, that's not the de minimis, Office or place of business in the state, but all clients are institutional. No, you have an office in the state, you have to be registered. So the answer is B. An investor must register with the estate if its assets under management it's below 100 million. Now be careful with this one. This is when you get kicked back to the state, right? So below 90 is that buffer between 90 and 110, right? Between 90 and 110, you belong to either one of them. But the answer here is A. Over 110, you're federally covered. And then if you are a federally covered investment advisor and you fall below 90, then you're going to get kicked back to the state. If an investment advisor, this comes up on Debrief all the time. I don't know why this is so challenging to folks. And maybe, if you're thinking, you're overthinking this thing. The registration expires on December 31st. I think people in their mind go, oh, it's it expires. And no, it's the 31st. So please, I don't know why this becomes such a big deal to people. So I'll just get rid of that. But Yeah, people tell me I don't know why they go backwards. It's December 31st. Without custody is 10. Broker dealers make money from all the following except commissions on issuer, non-issuer securities transaction. Yes. Markups when selling securities from inventory. Yes. Markdowns when buying into inventory. Yes. Fees from investment advice. No. Right. That would be, they'd need to set up an affiliate if they're going to do that. So these are how broker dealers make their money. And remember, the difference between that and that is called the spread, right? Right. A markup would be my ask price, and a markdown would be my bid price. My spread would be a buck there. All the following are exempt issuers under the Uniform Securities Act, except the U.S. government and its agencies, Fannie Mae, Freddie Mac, Ginnie Mae, yes. Municipalities, yes. The Canadian government and its provinces. So on your exam, the Canadian sovereign government, Canada, and its provinces, British Columbia, for example, and its cities, Vancouver. Vancouver, British Columbia, Vancouver is no different than Los Angeles on this exam. British Columbia is no different than California on this exam. And so is the federal government of Canada. Now, the Canadians are the only one that is true of. The Republic of Mexico, or any sovereign government we have diplomatic relationships would be an exempt issuer, but not its provinces. So, Ensenada is a city in Baja California. Ensenada is not like Vancouver, and Baja California is not like British Columbia. No. So this one is the wrong answer. I'm not sure what I would do with this except question, annotated, poor man's flashcard. I'll leave it to you to decide. The easy accessible record keeping for an investment advisor is 5 years with 2 years at the principal office. Which of the following are true of an access person? This is very high probability. Very high probability. The access person must file quarterly transaction reports with the investment advisor's chief compliance officer. The access person must send duplicate confirms. No, the access person does not have accounts. No, every natural person is employed is no. So the answer there is A. That is very high probability on the exam. So if you're making flashcards, that would be the one to do. Which of the following describes the personnel of the investment advisory firm? That would be 2B. 2A is about the firm, 2B is about the people. Broker dealers must register with all the following except the SEC. They most certainly do. There's no such thing as a broker dealer that isn't registered with the SEC. There's no such thing as a broker dealer that is not a member of the self-regulatory organization known as FINRA. And a broker dealer certainly has to register with any state in which it has an office. So by process of elimination, the answer here is D. Mother buys 100 shares for $3,000. She dies. At the time of the death, the market value of the 100 shares was $5,000. The daughter inherits the stock. This is called the step up. Now be careful whether you're being asked on the exam about in a situation where somebody inherits it, where the person who inherited the heir, there's a step up in the basis and it's 5,000. There's going to be a different from this if it was a gift. So be careful whether it's a gift or, it's a inherited situation. Now, I didn't choose this language here. This is language people tell me they've encountered on the actual 66. A broker dealer must register with the state in which of the following circumstances: I have no office in the state and I only call on issuers. I don't have to register with the state. I have no office in the state. I call on other broker dealers. I don't need to register in the state. I have no office in the state and I have fewer than 6 retail clients. I have to register. What I'm getting at here is there's a lot of people get hung up. There is no de minimis. There is no de minimis for a broker dealer. A broker dealer has one retail customer in the state. They're going to have to register. So no office in the state, and Canadians, you're a Canadian broker dealer and you're calling on Canadian snowbirds. You're Canadian citizens, right? Federally covered securities include all the following: a New York Stock Exchange listed security, indeed; a NASDAQ security, indeed; and non-NASDAQ OTC stock. That's a bulletin board pink sheet stock. Absolutely not. Maybe as a poor man's flashcard, I get rid of this. And boom. For which of the following would a notice be most appropriate, where you just tell the state administrator you plan on selling the security in their state? A mutual fund, right? Mutual funds are federally covered. Oh, by the way, those are not notice filings. Those are typically this one's going to be qualification. That may be an exempt issue, but that's not what the question was about. The question is about notice filing. Which of the following are not sales under the Uniform Securities Act? So what we're saying here is there's an offer accepted becomes a sale. And does the state administrator care about it? Do they have jurisdiction? The state administrator doesn't care about the gift of non-assessable stock. I mean, they don't care if you want to give somebody stock that cannot have where they can't demand a capital call. The state administrator doesn't care if the issuer declares a stock dividend or a stock split. Recently Apple split 4-for-1, Tesla split 5-for-1. Nobody had to pay anything for the additional shares they're receiving. State administrator does not care. If I'm a creditor and you pledge to me securities as collateral for that loan, and you default on the loan and I need to liquidate the securities, I need not worry about the Uniform Securities Act. Securities issued from an approved merger or business reorganization. So, Disney made an acquisition of Fox and they paid for it with Disney stock. So Disney stock was issued from an approved merger or business reorganization. A state administrator doesn't care. 1, 2, 3, and 4. The administrator has jurisdiction over all the following offers except an offer originated in the administrator's state. Absolutely. Directed into the administrator's estate. Yep. Accepted the administrator's estate. Yep. This is, the test point here is just because I drew a check on a bank that was in the administrator's state. So I'm coming to you from Clark County, Las Vegas, Nevada, and maybe I pay for the investment and the check is drawn on a bank, or maybe I wire funds or however I do it on a bank in North Dakota. North Dakota has no jurisdiction over that just because the check was mailed from. The same thing would be for a transfer agent. So the bank and then where the transfer agent is located. So, maybe the transfer agent for the stock is Colorado. And so the, stock certificate sent to Colorado from Colorado. Colorado has no jurisdiction. Warren Buffett uses fundamental analysis for a valuation of securities, and his performance has beat the market. What form of efficient market hypothesis says that this is possible? So we said there are 3 forms, right? And this would be the weak form. Well, the weak form says it is possible for Mr. Buffett to have not give up belief in the efficient market hypothesis, but suggests that the reason Warren can do that is because I am a believer in the weak form of the efficient market hypothesis. By the way, in this practice file, I give you all 3 versions of this. Your customer believes the efficient market hypothesis in its strongest form. So remember that means that, nothing can beat the market. So I would buy an index fund. These believe that I can actually, with active management, maybe outperform. This says I'm never going to underperform. I'm never going to underperform with an index fund. I'm going to accept a market-based return. All the following are true about criminal penalties on the Uniform Securities Act, except criminal penalties. So go to jail. You have 60 days to appeal. I think we brought that up. Right of rescission is about civil matters. So the answer here is C. The right of rescission is where we go to the person and say, hey, we blew it. We, this isn't about somebody going to jail. This is about approaching the investor and saying we didn't properly blue sky the issue. Blue sky is the colloquial term for either my broker dealer wasn't registered, I wasn't registered, the security wasn't registered. And so if you'd like, you can rescind the sale We'll give you back your principal and interest. You have 30 days to decide. That isn't associated with the criminal penalties of the Uniform Securities Act. You should definitely know this. So I'm kind of not sure whether I should tell you to get rid of the accept here and get rid of the right of rescission, or whether you should keep that. I'll leave it to you to decide how you want to incorporate that into your study effort, your study resources. Fees made by a broker dealer must notify customers at least how many days in advance, because you have an opportunity here to decide whether or not that's a deal breaker for you, right? And if so, maybe you take your business elsewhere. A registered person can use which of the following, a registered person's use of which of the following would be misrepresentation. Now, assuming you have a CFP or an MBA or a CFA, those are perfectly okay. But boy, no, you can underneath your card spell out investment advisor representative, but you can't make that sound like that's some professional designation. This is called in the exam misuse of professional designations. Misuse of professional designation. So again, it would still be misuse of a professional designation if you don't have one, right? If you don't have one of these, then you can't do that. This comes up a lot on the exam. I told you a lot of people struggle on the legal component of the exam. And what is a hedge clause? Yeah, I had an attorney take the exam. I've had over the years several attorneys take the exam, because remember, if the legal advice is not incidental and the attorney is going to start charging you for investment advice, they need to register. That late exemption is if it's incidental. Anyways, long story short, it'd be embarrassing if they don't pass, because this is a big component, it is legal component of the test, right? And expulcatory clause is what the guy said. A hedge clause is where I tell you in the investment advisory contract that I may be ripping you off, and if so, you will not hold me accountable, or that while the Investment Advisor Act requires written consent of the assignment of your investment advisory contract, you're waiving that for me, and I can do these are all what we call hedge clauses. Maybe I put in there that even if I am non-compliant, you're not going to sue me. So what the state administrator is saying here is you can't put any kind of a clause into an investment advisory contract that negates the requirements that are necessary. Like the investment advisory fee is necessary in that contract, the formula, the duration of the contract. So a hedge clause legally means, but by the way, this also applies to like research reports. A hedge clause is where no matter what I say, I'm covered. I say on page 1, interest rates are rising. Page 5, I say interest rates will remain stable. Page 10, I say interest rates are going to go down. Those are all inconsistent. And those again would be considered kind of a hedge clause where I've got so many clauses in there that there's no way I can possibly be wrong. As it applies to the investment advisory contract, it's where you write a contract that isn't compliant with the requirements, where you're asking people to waive you something that they, you can't make them waive any of the requirements in that contract. So just know what that means legally in terms of legalese. Which describes the firm, that's 2A. If there are material changes to the brochure since the last annual update, how many days from year end to deliver the updated brochure? That's 120 days. I get all the times on people telling me they got asked about the solicitor's brochure. Include which of the following: the name of the solicitor? Absolutely. The broker, in this case, if it's a broker dealer, the broker dealer. The name of the federally covered investment advisor. Gamma Global Investments was my broker dealer. And Gamma Global Investment was a solicitor for a federally covered advisor. So here's a brochure that tells you about Gamma Global, and the federally covered advisor is Carlyle. And here's a brochure that tells you about Carlyle. I tell you about the nature between the solicitor, Gamma Global, and Carlyle, that Gamma Global has been hired by Carlyle as a third-party solicitor to go find limited partners for their funds. And then we have to tell you about the compensation we're going to receive. I say, you pay 2% of assets under management, and, Gamma Global gets that first 2% paid by the investment advisor. They're going to give that to us as our fee for going to find you to invest in the fund. Does it cost you any more? I have to tell you. I said, well, in this case, it doesn't. I mean, if it does, I have to tell you. In this case, it doesn't, because you would have paid 2%. You're still paying 2%. But if it was an additional 1% or whatever, I'd have to describe that. 1, 2, 3, 4. I'd make sure you got that. So, maybe you want to screenshot this and print it and have it as one of your flashcards. All the following are credited investors except. This is the most recently started showing up on the exam. And it makes sense to me because, the SEC has broadened the definition of accredited, and the North American Security Administrator Association, NASA, who's in charge of this 66, probably have got all kinds of people confused running around thinking they know what this rule says. So you shouldn't be struggling with A, you should not be struggling with B, you should not be struggling with C. Now, this is the most recent update of this, but the language from the SEC is you have to be in good standing. And what they mean by good standing, the actual language in that SEC language is good standing in compliance with FINRA rules and state rules. Now, the practical effect of that in terms of interpretation is that just taking the 65, which does not require sponsorship, does not make you an accredited investor. You would have to be a 65 with an investment advisor, your firm, and then you're the 65. And then a 7, same thing, right? It's just not taking the 7. Now, 7 requires sponsorship, but that means on this side of the house, 766, you would have to have a 766 that is active with the broker dealer. So this is kind of a recent thing that's been showing up on the 66. Money laundering red flags have been showing up. So what are some red flags on a money laundering? So, the transactions you're doing are commercially illogical. The source of the funds, where are these funds coming from? Cross-border transactions, is it again coming from a jurisdiction like Monaco, or for example, or Liechtenstein or the Caymans? Doesn't mean it's money laundering, but it's a red flag. Something needs to be investigated. You tell me, I say, hey, listen, I always use the example. I was buying a Harley, and the guy said it's not going to leave the lot without with that personal check, and I went and got the Harley dealer a cashier's check for 21. And then I got a copy of the CTR, the currency transaction report that he filed on me. Now, what would have triggered a SAR, suspicious activity report, is if he told me that. I said, I'm so glad you told me that. Now Dean comes back with 3 cashier's checks for 7. So, the avoidance of triggering the CTR, which is the 10 grand, would also be something that would be, a red flag. Why is this person structuring? By the way, that's called structuring. Structuring means you're trying to avoid triggering, the CTR. So it's, again, 1, 2, 3, 4. And then I would know that every broker dealer and every investment advisory firm has to have what are called written supervisory procedures. And in those written supervisory procedures, there has to be a section on anti-money laundering. And, we're going to ask every new hire to read this thing and sign it that they read it and they understood it. Again, solicitor, you're going to get tested on solicitors. The solicitor's disclosure brochure and agreement must include which of the following except. The agreement between the investment advisor and the third-party solicitor must be in written form. That's true. A statement that the solicitor will be paid by the investment advisor. That's true. The additional amount of the investment advisory fee that will be charged if the third party. That's true. The solicitor brochure describes the nature of relationship between the solicitor and the investment advisor. Then it not be delivered. No. Remember, no, I can't incorporate, have one brochure, right? Because that would confuse the customer again about that relationship, and they might misconstrue that I'm an independent person from the investment advisor. So D, no. You got to deliver both brochures. Trusts are used for all of the following except estate planning. Yes. Again, this comes from Debrief. Void probate. Yes. Lower estate taxes. Yes. No, there's going to be more paperwork. So you're not going to have less paperwork with the trust. You're going to have more paperwork. Again, the main takeaway is not so much the except, is these reasons why somebody might consider a trust. So maybe, again, you want to get rid of that and get rid of the except. What is the difference between Class A shares and Class B shares? Class A shares are no load. Class B shares are no load. They're really on the misuse of no load terminology. Class A's have Class A's have an upfront. Boom, there we go. And Class B, again, I would get rid of this, and maybe I use this as a flashcard. and know how A and B shares are different. Partnership interest in the investment advisor that changes control. Because remember, there's a change in control, then that triggers the assignment thing. So minority partner retiring, transfer partnership interest to a new partner. A new partner means this, we're assuming here, there's no problem there. Minority partner transfer their partnership interest to their living trust. No change in control. A minority partner with 31% acquires a 20% partnership. Oh, so that now puts them at 51. And that now means there's been a change in control. The minority partner leaves the firm and keeps their partnership interests, go limited and just collect their distributions. No, the answer there is C. The answer there is C. 12B1 fees include all the following except. Again, I think I've had this question twice. I think it's the question. Just want to make sure you got that. All the following are true of letters of intent except, therefore 13 months. That's true. They can be backdated in 90 days. That's true. With a letter of intent, the investor gets a reduced sales charge with their initial investment. That's true. With a letter of intent, whether the investor gets a reduced sales charge with their initial investment or when they cross the break point, no, that's false. Make sure on the exam. So what I was getting at this question, I'm not sure if I got at it in a way that I feel comfortable with. Maybe I'll redo this, give this another shot in practice final 2 whenever I get that done. But make sure you can contrast a letter of intent with rights of accumulation on your exam. With a letter of intent, you get the reduced sales charge up front, and and rights of accumulation, you get it when you cross the break point, and you're getting no rebate. So make sure you can contrast those 2 scenarios on your exam. Client dies and leaves the IRA to relatives. All the following are true except a copy of the death certificate is required. That's true. Notification is made to the broker dealer. Yeah, somebody tells us the client's died. Sure. True. Reference to the designation beneficiary form may be made. That's true. By the way, this is the thing that on Debrief people tell me they see this thing. And so here I'm just trying to come up with an example of where you might see this. So I'm not quite sure what they're getting at on the 66 about this form, but somebody has told me they've had to, deal with this as a test issue. If the account was registered as transfer on death, no paperwork is necessary. The transfer will take place automatically. That is not true. So the answer is D. Now, what I'm trying to get to is the idea of this designation beneficiary form. By the way, the IRA wouldn't be registered as transfer on death. The IRA would have a beneficiary. What can create an error in a tracking? Again, this comes from Debrief. I came up with what I think could cause a tracking error. Not what I think, what could cause a tracking error. I'm not sure on Debrief if they're getting all of these or one of these. So I just decided to use the old reliable multiple to do this. And so investment advisory fees could cause a tracking error because you're taking money out of the portfolio. Lending the securities in the portfolio to people who wish to go short will bring in additional money. So, that would be something it could cause a tracking error. Cash balances, we're not fully invested in the index. That could cause an error in tracking, and the rebalancing of the fund's portfolio every now and again could do it. So D. Now, again, I'm not sure which one of these. My guess would be the main one they're probably looking for on the exam would be this one, would be my guess. An investment advisor representative is named trustee of the client's estate. Again, this comes from Debrief. All the following are true except, and again, I'm not sure how close I'm coming to this particular question in Debrief, but it's this thing about trustee. This is now considered custody of the client's securities. No, it's not. That is not true. That's true. That's true. That's true. And so, that's A. So again, this is one I'm not quite sure how close I am. But this is what people tell me they encounter is this idea. And then they get asked about, is that considered custody? And the answer is it's not. Private fund or the investment company. So these are hedge funds, private equity funds, venture capital funds. All the following are the private funds. Which of the 3 C? So what we're asking here is, how do you avoid being deemed to be a mutual fund? Right? They must have, my thing is here, I went to the following, must have 100 or fewer investors for 3C1. That's right. That's true. Investors must be accredited for fee 3C1. The investors must have 5 million in assets. Yes. The private funds must register. That is not true. It looks like I didn't get the accept format here. And what I should have done is get that. So, what I'm asking you here, this is true. This is true. This is true. What I was getting, it doesn't look like I've got that. I'll fix that slide later. Well, I guess I can do it now. Let me just fix it now. What are the following requirements? P.S. Let's just talk about this a little bit before I move on. Usually the private funds don't register with the SEC. The investment advisor to the fund does, but not the fund itself. So if you invest in, Kleiner Perkins Venture Capital Fund 8, the fund doesn't register, but Kleiner Perkins, the advisor to the fund, does. Or if you invest in a Blackstone fund or a Carlyle fund, or, the private fund isn't registered, but typically the investment advisor is. So D. Again, this comes from Debrief. I think it's kind of a weird question, but it is what it is, right? They said they got asked about an asset's book value. You don't get a whole lot of balance sheet, but we carry that on the books at the purchase price minus depreciation. So, again, that, my job is to try and do. I think it's a stupid something. By the way, trust you. Before I incorporate it into a practice final, I usually give some thought to who I received the debrief from. And in this case, I trust the debrief. A technical analyst would be looking at which of the following: fundamental analysis, fundamental analysis, fundamental analysis. All this stuff is what we call top-down analysis, and it's D, right? More demand for the stock goes up. More supply than the demand, the stock goes down. This would be charts, like a head and shoulders pattern, for example, something like that. So that's technical analysis. We're not really concerned about the underlying business as much as the stock. You would use technical analysis for more short-term kind of oriented investors. Use technical analysis, fundamental analysis, a little longer term in its perspective. What are the employer's requirements in administrating a 401k? Except this comes from Debrief. Chance for the employees to change the asset allocation. That's true. I'm looking for something that's false. There has to be 3 investment choices for the employees. That's true. One of the investment choices must be the employer's stock. No, they don't have to offer the employer's stock as one of the choices. And then, if we're matching you, for example, we say we're going to match you as your employer dollar for dollar in the first 3%. The money you're putting in the fund, you're immediately vested on, right? So if you're taking money out of your paycheck and you're putting in the 401k, that money was and will always be your money. And so that's true. Now, there's a vesting on the rest of it. So, if we're matching you dollar for dollar on the first 3%, and you leave 6 months from today, that money is not yours. We have to tell you what the vesting schedule is. Vesting means at what point is the money that we're matching become yours? It doesn't matter what it is. It could be 5 years, 20% a year, whatever, but we have to tell you about it. Again, this question comes from Debrief, as most of these questions do. An investment advisor uses third-party research. All the following are true except. So I'm looking for something, again, that's false. I told you I'm pretty heavy on the except format in this practice final because I want to be able to give you 3 things per question to kind of really beef up the amount of information that is in the question, right? So in these except, it allows me to give you 3 things instead of 1 thing. I could say which of the following is true, and then I can only ask you 1 thing. So, it's a bigger takeaway intellectually. Anyway, so use of third-party research as a basis of a recommendation need not be disclosed. That is true. So, if I'm using third-party research as a basis for me to make a recommendation to you, I don't need to tell you what that is. The use of the third-party research, if distributed to clients, must be attributed and disclosed. Yes. What I'm not allowed to do is snarl sometimes on the test is like, I'm dating myself. We used to have this thing called whiteout. And, maybe I reformat it, put it on my letterhead, and now it looks like I've done that analysis. No. So that's true. I have to tell you, whose research is it? C, the investment advisory firm can claim extensive research capabilities based on the number of subscriptions to third-party research. Absolutely not. So, maybe I say I cover 1,700 stocks. I rank them for timeliness and relative strength. Wow. You say, that's pretty impressive. I go, it is, isn't it? Unbeknownst to you, I just subscribed to Valueline. Valueline does that for me. Soft dollars may be used to purchase third-party research. Yeah, investment advisors can ask broker dealers to pay for third-party research. So again, this comes from Debrief. Yeah, I don't know what I would do in terms of a poor man's flashcard here. I think I'd probably just leave it as is and know what is true and what is false here. A firm fails to follow its own written supervisory procedures. So, I just told you every firm has to have this. The firm cannot be held accountable for not meeting its internal house requirements and its written supervisory procedures. It most certainly can. The firm can be held accountable by the regulatory authorities for not meeting its own house requirements. I like that a lot. Now, on your exam, make sure you read all the answer sets because, see, as long as its employees have signed an attestation saying they've read and understood the written supervisory procedures, the firm cannot be deemed to have failed to train and properly supervise its employees. That's false. That's false. The WSPs need not cover cybersecurity and social media. No, they must certainly cover that. Remember, I said they also got to cover anti-money laundering, and they also have to have, this is just a red herring to get you to bite on that one. The answer here is B. All the following are true of private funds except the funds are federally covered. The funds are exempt from registration with the SEC. That's true. The funds are exempt from registration on the Uniform Securities Act. That's true. The investment advisor is never required to register under the Investment Advisor Act of 1940. That is not true. So A is true. The funds are federally covered because these funds are typically sold under Reg D as private placements. So the funds are federally covered. The funds are exempt from registration. I told you the funds typically are exempt because, again, it's done under Reg D private. These are organized as private partnerships, private placements. And as a Reg D, it's exempt from both those. So that leaves us with D. Remember, private funds is those venture capital funds, private equity funds, hedge funds. Unit investment trusts. I've had people tell me they say UIT question every now and again. Unit investment trusts have all the following characteristics except they are subject to the Investment Company Act of 1940. That's true. The assets are professionally selected. That's true. They have passive management. That's true. They can be purchased on margin. They cannot because it's considered a new issue and new issues cannot be purchased on margin. Remember, it's considered a new issue 30 days from the effective date. So this would also be true of open-end funds as well. When a broker-dealer trades for its own account, these transactions are known as principal trades. That's what it means. When brokers act as agents for commissions, dealers act as principals for profits. Right? You should have been able to get rid of that one. Should have been able to get one of that one. That may or may not be from my own account. I could be doing a riskless principal trade too, but the most appropriate answer here is C. Which of the following is a non-issuer transaction? Again, this comes from Debrief, and issuer transactions are primary transactions where the issuer receives the money. A non-issuer transaction is known as a secondary transaction. That's where the issuer does not receive the money. And so we're looking for a transaction in which the issuer did not receive the money. What we're looking for is a secondary transaction. And again, this comes from Debrief. So this isn't Dean making this up. This is, stuff that, I collect. Secondary transactions. All those transactions together, by the way, are called the secondary market. All right. So a company sells, that would be primary. This would be primary. This is a secondary trade, right? The portfolio manager is selling. And a private fund selling, that's primary. So the answer here is P.S. The state administrator is more concerned with primary transactions than the state administrator is concerned with secondary transactions. You know, in the secondary market, it's more caveat emptor than it is in the primary market. All the following are true of accredited investors, except they must meet minimum criteria. The definite. Yep. It's, remember this, just because you're a accredited investor and I rip you off on the state administrator doesn't care about that. The state administrator says, if that's a doctor or an attorney or a car dealer and they're accredited, that doesn't mean anything other in my state, and they can participate in a Reg D private placement. And no, accredited investors are always natural persons. They're never unnatural persons. So the accredited investor is a natural person. You know, the institutional investors, perhaps, that are in the private placement, they are unnatural persons. Yeah, maybe get tired of Dean's stories, but you know, we were doing a partnership and the general partner said he didn't want any unnatural persons in the partnership. He only wanted natural persons, living, breathing human beings, because when he had partners meetings, he, you know, was a winery, so he wants to be able to, you know, have a glass of wine with a partner, not a pension plan, not, you know, so, you know, I can't tell you how many people would get upset when I said, no, your pension plan can't make this investment. It's got to be you as an individual. All the following are mandatory in a margin account, except, remember, in a margin account, we're using customer collateral to borrow money on behalf of the customer. So maybe make additional investments, whatever we're doing. But the loan consent form is where the broker dealer says to the customer, would it be okay if we lend your securities to other customers who wish to go short? And you say, well, I don't think it's in our best interest to help people go short stocks I'm long. It's not. And that's why the loan consent form is optional. Now that's the test points. I'm not going to turn this into a poor man's test thing. The credit agreement tells you understand that you're borrowing money and you're paying interest based on broker call, mandatory. The hypothecation agreement says you're pledging the securities of collateral for the loan, and therefore your securities will be in street name. That is mandatory. Right, the one's not mandatory is a loan consent form. All the following are true of closed-end funds, except you're going to get a question or two about distinctions between closed-end funds and open-end funds. And closed-end funds may have a higher public offering price than an NAV. So we're looking for something that is false. That is true. They may issue preferred stock and issue bonds and make additional investments in their specialty. That's true. Open-end funds cannot do that, but closed-end funds can do that. They must meet redemption requests. I'll have to clean that slide up. Must meet redemption requests. That is false. The whole point of a closed-end, one of the major points is, as a closed-end fund manager, I never have to meet redemption requests. I say, if you're unhappy with my funds, sell it to someone else for either more than or less than you bought them for. They trade in the secondary market. That's, by the way, this is the major testable distinction, is this one. They trade in the secondary market, whereas open-end funds are primary transactions. I would expect more than one question about the distinction between closed-end fund and open-end fund. All the following are true of dollar cost averaging, except it requires fixed dollars invested regularly. Indeed, that's what makes it work. It results in a lower average cost than the average price of the shares. That's true. That's why we do it. You're doing exactly what you should be doing, which is buying more shares when they're low and less shares when they're high. It's a built-in timing device. So A is true. B is true. Now, by the way, even if we don't know the next two, at least we're getting it to a 50-50, right? So, I mean, just even if we can't put T or F next to each of these, if we can get it closer, we're still accomplishing something. Boy, that should be a word that never comes out of your mouth. There's two words we never use in the securities industry. They are guarantee and approve. We never say anything's approved, and we never say anything is guaranteed. When selling shares purchased using dollar cost averaging, you have a choice about what shares to redeem or sell. Yeah, you can use average cost, first in, first out will be imposed on you if you don't, but you could use if you chose to. You could do LIFO, whatever you'd like to do. So that's true. An agent's registration is still pending. So this was somebody who told me they got a question about still pending. So this is my shot at what could this question be about, right? What can you do during stills pending? So I'm not sure if I got an answer set that reflects what you'll see, but I'm trying to come up with something that would, I think they might be looking for in this idea of a pending registration. The main thing is, right, is you're not effective yet. Begin sales efforts by contacting potential customers to inform them of your pending effective date. Yeah, help the mailroom. So this sounds, again, these kind of questions are judgment questions. And you got to say, okay, using your judgment, what do you think these is going to be the biggest problem? This doesn't sound like a problem at all. I say, why don't you go help them sell out mail, brochures? That doesn't sound like a problem. This doesn't sound like a problem. So given that answer set, I think that would be the potential problem, making public contact. This again comes from Debrief. And, help determine their investment objectives. Now, the experience is about the past, not what you want to do in the future. Help determine your investment goals. The past doesn't have anything to do with that. I mean, it might have something to do with where you're at presently and, in pursuit of those. Help determine your risk tolerance. Yeah. Right. If I see what you already own, I can say, okay, well, they seem to be comfortable with that portfolio already. And then I start from there, right? I say, well, are you comfortable with the present risk tolerance? Is there a time horizon? No, that would be something I would ask you. So given this answer set, C is the most appropriate answer. What asset must an agent disclose to the BD? So again, we're looking for in this answer set the most problematic. By the way, I think you should disclose all of these. I mean, the House requirement could certainly just ask you to disclose these, but which one of these is the most when as a compliance officer, I'd have the most concerned about. I'm not really concerned about you owning a mutual fund. I'm not so concerned about you going government securities report. This is what I'm concerned about. Is there some sub rosa relationship you have with this pink sheet stock, right? So again, I could make arguments that you could have all these, but again, what we're trying to get at here is the most problematic thing in the portfolio, and therefore the most likely thing that you should have disclosed to me at the broker dealer. This again comes from Debrief. What bit drives a firm's net worth? Assets minus liabilities equals net worth. That sounds pretty good. Check out the answer set. Allowable assets minus liabilities. There's no such thing as allowable, non-allowable assets as relates to net worth on 66. That is certainly a concept that outside of 66 can be a problem. Liquid assets, no, it's A. Now, the stupid, but somebody tells me they encounter sometimes is a sofa a part of the firm's net worth. Again, there every once in a while there's crazy questions. And yeah, I mean, it's an asset. I don't know what kind of asset it would be, but it's an asset. Stop orders can be used for all the following: to stop losses. Absolutely. Protect a profit, establish a stock position. No, that would be a limit order. That's not a stop order. This is the other version of this question again. So please note, mom didn't die this time. She's gifting it. So mother buys 100 shares for $3,000. She gifts it to her daughter. At the time of the gift, the market value is 5. The daughter sells several years later for 9. And in this case, there isn't a step up. The daughter's cost base, she's going to assume her mom's cost base. So when the securities are gifted, the donee, the person who received it, assumes the donor's cost base. So just make sure you're reading carefully. There's a difference between the gift and there's a difference between somebody dies. So basically, this is the same version of the question that we saw last time, but now it's a gift and somebody did not die. When accepting an order from a third party, which of the following is true? The person who's the third party has to have written authorization to be making third party, decisions. Which of the following is true? Again, somebody told me they got this question about commingling versus segregation. A firm may commingle customers' monies and securities. We can have one account where we commingle customers' monies and securities. A firm must segregate customers' monies and securities. That's not true. A firm may commingle the firm's monies and securities with that of the customers. That's not true. That means your securities, my securities. What's it matter? A firm does not need to segregate its money. No, that's not true. It's A. So Again, I'm not sure I like my answer set in this question a whole lot, but what I'm trying to get at is broker dealers must always segregate their monies and securities from that of its customers, the firm, I should say, the investment advisory firm or the broker dealer. But we can have a common customer account. That would be okay. It's not best practice, but it's okay. All right. So I try and keep these, I go quick because you have a pause button, and I try and, keep these at some reasonable things. But remember, you can pause along the way. I hope you found that helpful. Again, in terms of our channel, what we do is we collect a debrief, and we get enough questions to sustain a practice final to help us practice, drill, and rehearse. We put that up there. So there will be a Series 66 exam practice final 2 at some point. We've got 3 on the 7. We're working on the 4th. We have a final on the SIE, but there's another one coming for that. And, we're almost done with the test specifications. So that's kind of where we stand. And so I will be publishing this to the channel presently. Like, share, subscribe, do all that good stuff. And I'll talk to you for our next installment. I'll probably be putting something up on the 24 pretty quickly, and finish up the test specifications on 66. So you can look forward to some future content, either explications, practice finals, or narrative lectures.